Good morning. It's Wednesday, the 29th of April, and welcome to our Ask Me Anything live webinar. For those of you watching this on a recording, we host these webinars once a month, and really this is designed to answer any questions that really are circulating around in your world, whether that's questions about the markets, financial planning, tax planning. We really want to be a great resource for you here so that your portfolio is aligned with your goals. A quick bit of housekeeping. We do have uh, at the at the bottom of the page here, you'll see a chat feature. That's where you can put your questions that you would like answered. More than happy to answer them on the fly. We did have some that were sent in ahead of time, which is fantastic. If there's anything confidential, please don't put that on an open chat that's going to be published. We can have an offline discussion for that, of course. Last little bit of disclosure. This is a general information webinar. Some of the topics may be, or some of the answers may be contrary to what's best for your personal situation. So it is important to have the right context for this. So with that, we'll go ahead and get started. For those of you in attendance, I see we have a couple people coming online, which is fantastic. Please feel free to throw your questions in the chat, but I'll go ahead and get started with some of the ones that were sent in ahead of time, and that way that'll give us time for the Q&As to load in the chat. First question that came in, Sean, oil prices are up. If oil prices stay elevated, what does that mean for the markets? It's really a great question. Whenever you hear oil prices up, especially for those of us who've been around for a while, we remember the high inflation days of the late 70s and 80s when oil prices and an OPEC boycott drove inflation through the roof and created massive headwinds for our economy. Times are very different now than they were back in the late 70s and 80s. The United States is much more of an oil exporter than an importer. And we do have enough oil here domestically to fund our own operations. That being said, the price of oil is still a global price. And it is all based on what happens around in the Middle East and the like. So, a couple of things to keep in mind. Yes, oil prices are up, and therefore, every time we go to fill the gas tank, we are seeing that come out of our pocket. And so, if you're retired and living off of fixed income, this is certainly eating into your cash flow for the month. But from an economic standpoint, most companies that have oil and gas as part of their logistics, they run very complicated futures contracts and have some insulation against short-term oil price spikes built in so that it doesn't immediately impact their profitability. Now, as part of the reason why we say that, yes, higher oil prices are inflationary, but they're very slow to build. It does take time for those oil prices to seep into the overall inflation number. It's going to impact the consumer first before it impacts corporations. But the longer this goes on, the more we're going to see inflation go up based on higher oil prices. So it's a very real concern. The problem is it's not a day-to-day. This is more rolling 90 days, rolling 6 months. But when you ask about what it's going to do for the markets, obviously there's a lot of emotion built into the markets right now. And sort of bad news, we do see the markets pulling back. When oil prices first started going up after the initial launch of the Iran campaign, yes, it created a quick headwind for the markets. A lot of that, though, is the uncertainty of everything, not a direct relationship to oil prices. How long are they going to be up? How long are we going to be in this conflict? Are there going to be boots on the ground? All of that uncertainty is was weighing on the markets, not just the oil price itself. Um, Two, when you look at oil prices, when you look at what is what moves the market, when the administration announced, okay, we think it's going to be over in a couple of weeks, or we've come to an agreement on a ceasefire, the market rallied, right? Because some of that uncertainty was removed. It came right back as the ceasefire, while it's holding, they're not coming to an agreement. But it is something that is a long-term, excuse me, a short-term concern of day-to-day price movements. Do I think you should move your portfolio around? If you happened to own energy stocks or energy sector funds prior to all of this and they've run up aggressively in the last 6 months, maybe it's time to consider taking some profits. But otherwise, I wouldn't overly worry about high oil prices impacting the markets on a day-to-day basis. To me, it's much more of a where are we in 6 months? Where are we at the end of the year on oil prices? And I think that's much, much more important and, of course, harder to predict. I hope that answers your question. The next question came in. I keep hearing such negative news about the economy, but the stock market keeps going up. What gives? It's a tough one to understand. So, there's a couple of things to think about when you look at the stock market and you look at the economy. For years and years, when I was an advisor, I started my career in 2000. We were always taught the stock market is a leading indicator of the economy. If the economy is forecasted to show strength, then the stock market should go up. If the economy is forecasted to show weakness, then the stock market should fall. But that's not happening right now. One of the things that it's really important to keep in mind is that the stock market has a 96% correlation to earnings. Corporate America, the health of individual companies, at least public companies. And right now, corporate America is very healthy. We are seeing earnings grow and grow and grow year after year. Ever since the Fed stopped raising rates in 2021. So when you look at corporate America, they're really healthy. And because earnings keep coming in to justify some of these higher valuations, that just propels the stock market higher. Now, this week is a big week. We're the last week of April. A lot of the Mag 7 reports this week. And so we'll have a lot more clarity about how real the AI revolution is, what any sort of hiccups we could see in the earnings later this week. But again, it's just one quarter's worth of earnings. So yes, when you think about why is the stock market going up, it has more to do with the earnings side than the overall economy. On the economy side, we are seeing signs of weakness. There are some real concerns in the economy. We're seeing debt payments being missed, so delinquency rates are rising. We are seeing some layers of the consumer struggling, there's no doubt. But for now, earnings are able to erode what the weakness in the economy. But that side shouldn't be ignored. There are some real weaknesses. And the reason I say it shouldn't be ignored is if and when the earnings story no longer can carry the market higher, then all of those cracks in the foundation of the economy, those are going to become really apparent very quick. So it's something to be aware of. It's something to monitor. It's something we monitor on a weekly basis here at CV Wealth. But hopefully that explains why you're hearing such negative news, or unemployment rates, things like that, when you listen to the news or read the headlines or watch social media, versus why the stock market just seems to keep going up and up. So it's a great question, and I'm really glad it was brought up. Next question. What are your thoughts on the traditional 60/40 retirees portfolio? Uh, you know, Good question, but we'll start there. Um, the 60/40 portfolio is what we were taught for years as this is what you should put into your retired client should be in a 60/40 portfolio, and they'll never have to worry about anything again. And to me, it's really overly simplistic. When I look at client portfolios, to me, it's a function of your spending rate. How much are you drawing out of your portfolio versus what the allocation of the portfolio should be? If you only have, say, a 2% withdrawal rate, you only need 2% of your portfolio to fund everything you want to do in life, then 40% of your portfolio is 20 years worth of spending. That just seems a little conservative to me, especially if you're trying to leave a legacy to heirs and things like that. If you're running a full 4, maybe even 5% burn rate off of your portfolio, that's different. Now you're talking anywhere between 10 and 8 years worth of spending. That might make a lot more sense. It really does it comes down to your spending rate off of the portfolio. And keep in mind, spending rates change. If you haven't collected Social Security yet, that will be future income. So your spending rate may be a little higher now, but your future spending rate will be lower. If you have not started required minimum distributions, that's another set of forced income. So what your spending rate is, what your forced distribution rate is, to me, is a much better way to plan and to what I jokingly call reverse engineer your allocation. I would much rather build an allocation for clients based on their spending goals, based on their tax planning goals. If you're up against a IRMA or the Medicare surcharge tier, then maybe it makes a lot of sense to do a return of capital, and spend some cash so that you don't overpay in IRMA. I think the 60/40 rule is a little simplistic. I think there's a better approach. So I'll leave it at that. If there are any follow-up questions, please throw your questions into the webinar chat and I will address them there. Next question. I am 77 years old and retired. I have high yield savings accounts, CDs, a Roth, an individual 401k. The question I have, in what order should I make withdrawals when the time comes? It's a great question. So this to me speaks to what's called asset location. Where do you have your money and how much of your money is liquid versus how much of your money is tax deferred, meaning the IRS still owns some of your retirement versus how much of your portfolio is tax free. So portfolio withdrawals, it depends on a couple of factors. And I know I hate the it depends answers, but in this case, it really does. It depends on your spending rate. How much of your portfolio do you need to live off of after Social Security and required distributions, things like that. 2, it depends on the tax basis of anything that's in your liquid account. If you have you've owned index funds since the 90s and it's worth 5, 6, 7 times what you paid for it, all with unrealized capital gains. Long-term capital gains are great, depending on if you're in the 15 to 23.8% capital gains rate. That's one factor. Where are you on your IRMA surcharges? How much, what tier are you on? Where are you on your ordinary income bracket? Are you filling up a bracket? Is there room? Are you actively doing Roth conversions? How much of the portfolio is your rollover IRA, individual 401k, all of those tax deferred accounts? if you have a large chunk of those, then your required distributions are going to be larger, forcing income on you. Uh, if they are a small component, then that changes the calculus on cash flow planning. It really also comes down to goals. What's most important? Is it predictability of cash flow? Is it tax mitigation, right? Minimizing the lifetime amount of taxes that you're going to pay? Is it leaving a legacy? I want to leave the cleanest sort of legacy possible. And so I'm willing to pay a little extra tax while I'm alive so that my kids get a step up in basis or Roth IRAs, things like that. So this would have to be modeled out based on spending rate, goals, priorities, things like that. General rule, though, and again, I don't like general rules. I like reverse engineering, but general rule is really focusing on what gives you the most predictability for your cash flow. A lot of times when retirees are in that distribution phase of retirement, we're no longer accumulating. A downturn in their investments is much harder to recover from. So for me, I would want to make sure that whatever your source of withdrawals is going to be comes from either no or low volatility based investments, so that if there is a pullback, for whatever reason, normal correction of 10%, a bear market correction, which happens every 3 to 5 years of up to 20%. Again, very statistically probable. I'd want to make sure that you're not relying on that money to fund your expenses in 2026, 2027 type concepts. So general rule, obviously CDs are great. They're illiquid, so you have to, you don't want to pay fees to get out of CDs. Roth IRAs, by definition, you already paid the tax, so we want that to be the last source of income that you take. That being said, there are times for certain clients that a small amount of Roth withdrawal keeps clients from jumping to the next tax bracket or the next IRMA tier. So it's much more tax efficient to do a small portion of a Roth distribution. But in general, try to avoid the Roth. Have your liquid accounts, your high yield savings accounts, your CDs as a way to keep your tax rates low. Take your required distributions from the individual 401k, your IRAs, things like that, and try to manage the tax situation that way. Hope that answers it. But I promise you, there's a lot more tailoring that can be done than general advice. So I hope that answers your question. Next one. Is it too late to add gold to my portfolio? Okay. Tough question. So gold's been on a massive run, right, over the last couple of years. And gold has been an inflation hedge. Gold as an inverse holding to the US dollar. So when you ask about should you add gold to your portfolio right now, gold would be bought in a scenario where you believe a couple of things. Inflation's going to go back up from here. And two, that the US dollar is going to continue to be weak. We're going to lose value against gold and other currencies around the world. It is a flight to safety assets historically. So when the market has a crisis on its hand, typically gold goes up, but again, not always. So I think after the run it's had, I think you have to be strategic about gold at this point. Not opposed to it. I certainly wouldn't put 25, 30, 50% of my portfolio in it. But a small percentage of gold as an inflation hedge, yeah, it can make a lot of sense. Especially if you have a long time horizon, if you're recently retired. So, I would say potentially yes. I do also think it matters how you own gold. There are ETFs out there that have underlying gold reserves, and there are ETFs out there that are proxies that use derivatives around the price of gold. I would want to own the ETFs that have gold behind them, not the derivative based. I also wouldn't want to hold gold under the mattress, so to speak. Don't go and buy gold bricks and stick them in a safe, because now you're subject to some sort of commission, a price discrepancy on the the buy ask bid spread. So if you own gold coins, fine, but you know the Costco bricks, it was always, when those got announced, it was fun to talk about. So that's kind of the outlook for gold. Certainly applicable in a lot of cases and a lot of portfolios, especially if you're worried about a declining dollar and therefore higher inflation. Okay. Next question. Actually, I'll pause there. For those of you in attendance, please feel free to add any questions that you want to add. Would love to have you throw anything into the Q&A live. Otherwise, I'll keep going down the ones that were pre-submitted. What do you expect from the new Fed chair? Okay. So Chairman Powell is, his term as Fed chair is up here in a couple of weeks. And while his term on the Fed is not up for a number of years, his term as chair is. And I think that's an important distinction. There's a lot of confusion out there of he's going to be off the Fed and therefore he's not going to have a voice or a vote on future monetary policy. And that's just simply not true. As of now, Kevin Warsh has yet to be confirmed by the Senate to be the new Fed chair. And Chairman Powell has said he will stay on as Fed chair until the new chair is confirmed, which falls in line with historical precedent. That's not something that's outrageous. There was a bunch of political maneuvering, especially by Senator Thom Tillis, the outgoing senator who's the head of the Senate Banking Committee, and the DOJ investigation into Chairman Powell. That recently got dropped, which was Senator Tillis's objection and why he was holding up the nomination. So as of now, everything should move forward. I'd be surprised if Kevin Warsh was not added to the Fed. We have a Fed meeting later today. We don't expect any rate changes today based on the data. But going forward, what's likely to change? Obviously, the Fed chair does have a larger voice in the room when it comes to monetary policy. That being said, it's not a unilateral voice. There is still the Fed board members that vote. And while there may be some dissensions and the like, there's still plenty of votes of the Fed members who are going to be more data dependent than focusing on the administration's goals of lowering interest rates. So short answer, I'm not sure there's going to be a lot of structural change. Right now, going into the beginning of the year, we were looking at 2 to 3 cuts by the Fed this year. That has come down to 0 to 1 based on oil prices going up and the Iran conflict and the uncertainty around that. So do I think I think this maybe tilts the percentages back to 1 cut versus 0 a little bit, but not much, really. I don't think this is a major change to the Fed. I think they're still going to be data dependent. There are some current Fed members who are talking about raising rates here, not cutting. So I think it'll be very interesting to watch, but I don't think it has a material change where we're going to see interest rates dropped by 100 basis points or 4 cuts, and we're going to see mortgage rates drop below 5%. No, I don't think we're going to see that, even with the new Fed chair. So, all right, next question. What worries you the most right now? What worries me the most when it comes to helping clients with their portfolios is a couple of things. One is, the stock market has been, I'll say there's three things that really I think about a lot. One is the stock market has been on a very long bull market run. And there are two types of bull markets. There's what's called a secular and a cyclical bull market. A secular bull market is kind of, if you think about the ocean tides, tides come in, tides go out. A secular bull market is where the tides are coming in. And that's what we've seen since the housing crisis of 2008, which trickled into, early 2009. Since then, the tides have been in our favor. We've seen interest rate cuts. Yes, there were hikes. We've seen monetary policy supportive of the markets. We've seen a massive amount of corporate buybacks. We've seen tax policy that's pro-business, regulatory policy that's pro-business. The stock market has been on a very long secular bull market. We've had some cyclical bears along the way, which is common, but we haven't seen a change in the tides in a long time. And I'm not saying we're going to anytime soon. There are some really positive things happening in the markets and in the economy. As I mentioned, corporate America is very healthy. But eventually, secular markets end, and there will be a reversion in the trend. And I'm not trying to scare anyone. I'm not trying to predict it, but I am aware that these things do end over time. And so for me, I worry about making sure that the complacency of the markets, that portfolios, especially if you're living off of your portfolio, that you are prepared for the secular bull market to end at some point. And I don't know how it's going to end, whether it just kind of goes sideways for a number of years, or if we have a massive pullback and recession. Who knows? Anyone who tells you is full of it. But we do know that it is a very real statistical probability, and we do need to be prepared for it. On the cyclical bull, ever since the Fed stopped hiking rates in 2021, that has launched a cyclical bull market. And going back to our ocean tides, yes, we have the tides coming in, but we also have high waves where the waves are up. Good for surfing, good for markets, but that's where we're at now. When you think about that is also getting long in the tooth. Those typically don't last over 4 or 5 years. We're 3.5 years in now. Eventually that will end. Will those two coincide? Will the cyclical and the secular end at the same time? Could one cause the other? It could. But I do worry that the market has been on a run, and these types of runs don't last. And so we have to be prepared for that. So that's the first thing I worry about. The second thing I worry about is the Fed. The Federal Reserve may be somewhat painted into a corner here shortly. And what I mean by that is the Fed has a dual mantra. They have two jobs: keep inflation in check and keep people employed, right? The unemployment rate. And typically the tools that they use, they only have to typically fight one battle or another. They don't typically have to fight both at the same time. But we're in a situation now where job unemployment is going up, and so is inflation. And the tool that the Fed likes to use of monetary policy is historically inflationary. To support jobs, they would either cut risks, cut rates, or work some sort of quantitative easing. which would be inflationary, which would be to support companies, make it cheaper for them to borrow money, therefore they would hire people. That's the revolving theory. But if you're also fighting inflation at the same time, that's a problem because those strategies are inflationary. We would see inflation go up. And so the Fed may have to pick the lesser of the two evils. And I think they'll choose jobs to start because that has a much bigger impact on the overall economy. But I think they're going to pick jobs up into a point. If and when inflation starts rising and the momentum carries and starts compounding, I think they're going to have to start fighting inflation, which means raising interest rates, which could turn into more job losses. Throw on top of that the AI revolution where jobs are being replaced with AI, and you've got some concerns. Now, there is some positive news. With the age wave, the baby boomers retiring out, there are a lot of jobs that are just simply not getting replaced. And so when you think about natural attrition within corporations, that actually helps the unemployment number because that's not people leaving the job force looking for new work. That's just people leaving the job force and those jobs going away, but it doesn't impact the unemployment rate. So that has been a tailwind for the unemployment rate. This next one's a little controversial, but it's true. Immigration policy. Less people coming into the country is less people looking for work. And, taking politics out of it, just from a data standpoint, if there's less people looking for work, that helps with the unemployment percentages. Right or wrong, we're not here to debate, but those two tailwinds are helping keep the unemployment rate in check, even though some of the job losses are going up. So yes, while AI is taking jobs, it's not as bad as you would think. Goldman Sachs this last week or 2 weeks ago said the net number, because AI is creating jobs as well, was only about 16,000 a month, which is frankly not a big number. That's less than 10% of the average month. So not horrible at this point. Could it accelerate? Of course. Could it become a bigger headwind for the economy and for the Fed? Absolutely. It's something we're worried about. But for now, those numbers are okay. But it will be interesting to see later this year, does the Fed have to pick between employment and inflation? And I wouldn't want to be in the room for that discussion. So not a fun place to be. All right, let's check the Q&A, see if there are any additional questions. I'll put a last call out here for Q&A. Okay. All right. So far, that's it. Well, I will go ahead and wrap it up early. I thank everyone for attending. If you had a question that you didn't want to ask publicly, please reach out to me here at Sean@cbwealth.com or give me a call. You can reply to the email that you got with this as well. One last thing, unfortunately, I will bring up the disclosures. Unfortunately, we do have some legal disclosures that the lawyers love for us to share. So let me bring that up here now. Boom. There we go. All right. So, again, this was general advice. If you have any questions, please reach out directly about your personal information. Not a big surprise. General template disclaimer stuff. So I thank everyone for attending today. Please reach out if you have questions. I will send out a replay of this. So if you wanted to watch it again, just let me know, send me a note, and I'm happy to send it out. Thank you all for attending. Have a great rest of the day. And thanks for attending. Bye-bye.